Oil just ripped 5% higher in a single session. Let me say that again. Brent crude has added over $3.75 since yesterday's settlement, and as I record this, we are trading at $75.75. That is a move of 5.21%. If you're sitting there watching this spike and thinking the bear trend is over, you might be right, but you might also be walking straight into one of the most vicious liquidity traps I've seen this year. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 2 scalp plays and 1 swing trade you can execute today. On screen, you can see exactly what I'm looking at. The number 75.75 and the phrase trap, 2 scalps plus 1 swing, are burned into the top of your screen for the first 15 seconds. Write that price down. Write down what the herd is doing. Because right now, the herd is panicking. The herd is chasing this spike, afraid of being left behind. And that, my friend, is exactly where the money is made. On the other side of panic. Let's start with the instant market verdict. The session bias is clear. We are in a violent short covering rally inside a bear market structure. Weekly trend is strong sell. Daily trend is strong sell. But on the 4-hour chart, the trend has flipped to strong buy, and on the 60-minute, it's also strong buy. That is the textbook definition of a counter-trend spike. These moves are fast, they are emotional, and they destroy accounts when you treat them like the start of a new bull run. My immediate bias for today's session is to trade the long side for scalps, but to approach any swing long with extreme caution unless one specific level breaks. And that level, the invalidation level that changes everything, is 78.37. That is the daily 20-period moving average. It sits way above us right now, and it is the line in the sand. Write this number down, 78.37. If Brent closes a daily candle above that level, the entire structure resets. The bear trend is suspended. I will flip my medium-term bias to neutral and start looking for sustained buying. Until then, every pop is a squeeze against stale shorts, and squeezes end. They always end. The herd is positioned net short after weeks of relentless selling. Speculative positioning data shows deep short accumulation near the recent lows. This spike is burning those shorts, and forced covering is the jet fuel. Once the covering exhausts, if real buyers don't step in, the air gets very thin very fast. That's why I call this a trap. It could be a trap for late shorts, or it could become a trap for breakout chasers. The 78.37 daily close will tell us which one. Now I'm going to take you through the technical deep dive from the weekly all the way down to the 60-minute, because this setup is so rich with narrative. On the weekly chart, Brent has been in a structural decline. The weekly 20 MA is sloping down, the 60 MA is sloping down, and the 200 MA on the weekly, well north of $90, acts as a gravitational ceiling. That weekly trend being a strong sell means any rally is still corrective until proven otherwise. On the daily chart, the moving averages tell the same story. The 5-day MA is at 73.44, the 10-day is at 74.29, price just blew through both of those today. The 20-day MA, as I said, is 78.37. The 50-day MA is all the way up at 86.20. The 100-day MA is 86.95, and the 200-day MA is 82.65. Notice something critical. All the major daily moving averages are above current price, even after this 5% surge. That means the daily trend structure is still firmly bearish. The RSI on the daily, which had been crushed down to the low 30s, is now recovering and sitting at 39.3. Still below 50. So we are not even at neutral momentum yet. This bounce is coming from deeply oversold conditions, and until RSI reclaims 50, the bears technically still own the intermediate time frame. MACD on the daily is at minus 5.87, deeply negative but beginning to curl. That curl is what draws in the dip buyers and the short coverers. The histogram is showing early signs of momentum shift, but no bullish cross yet. That's where the hidden divergence I'm about to show you comes in. Drop down to the 4-hour chart. Here the picture flips. The 4-hour trend is a strong buy. Price is sliced through the 4-hour moving averages like a hot knife through butter. The 5 and 10 period MAs on the 4-hour are pointing straight up. The 20 MA on the 4-hour has been broken convincingly. The ADX reading, which measures trend strength, is screaming 58.1 on the daily time frame, though that likely reflects the preceding sell-off's intensity, but on the 4-hour, ADX is also elevated, confirming this rally has power. The critical hidden divergence is this. On the daily chart, we have a massively oversold RSI that bottomed while price made lower lows late last week. That is a classic bullish momentum divergence. Many traders missed it because they were fixated on the downtrend. Now that divergence is playing out in real time as a sharp mean reversion spike. I call it the rubber band snap. It's violent, it's fast, and it typically retraces a portion of the prior decline before finding a new equilibrium. Where is that equilibrium? Let's look at price levels. The standard pivot point calculated from yesterday's range sits at 71.87. Support 1 is 71.13, support 2 70.28, support 3 69.54. Resistance 1 was 72.72, resistance 2 73.46, resistance 3 74.31. Now listen to me carefully. The current price of 75.75 is above all of those resistance levels. It blew through a 3 like it wasn't even there. That is a rare event, a breakout beyond the standard pivot resistance tier. When that happens, you cannot simply short the next resistance because there is no standard resistance left. You have to look for prior structural levels. I see the next meaningful resistance band between 76.50 and 77.20. That area was a swing low from a few weeks back that now acts as overhead supply. Above that, the psychological round number of $80 looms large, but the daily MA at 78.37 is the true beast. Support now flips. Older 3 at 74.31 becomes the first line of defense for the bulls. Below that, 72.72 and the pivot at 71.87 are the levels where I'd expect buyers to show up if this rally fades. Here's what most traders miss. The combination of a deeply negative daily MACD beginning to curl and an RSI that hasn't even hit 50 yet tells me this rally might have more room to run before it encounters true structural selling. The shorts that covered today did so out of pain, not conviction. But the real test comes when price approaches the first major overhead supply zone. That's between 76.50 and 78. If we get a daily close above 78.37, the probability of a sustained trend reversal skyrockets. Until then, this is a counter trend event with a shelf life. Now let's connect the fundamental driver, because this is what makes oil the geopolitical heartbeat. In the last 24 hours, the core news is that the United States revoked the general license for Iran oil sales. That's a big deal. It directly removes a stream of supply from the market. Estimates suggest up to 500,000 barrels a day could be affected. On top of that, fresh attacks on ships in the Gulf have escalated tensions. Insurance costs are spiking, shipping routes are being reassessed, and the geopolitical risk premium that had been completely priced out of crude during the sell-off is now rushing back in with a vengeance. Analysts are calling this a supply shock, and they're right. The market went from pricing a demand destruction narrative to a supply shock narrative in the space of one settlement. That's why the move is so violent. But here's the nuance. Geopolitical spikes have a history of fading unless actual physical barrels are disrupted in a sustained way. We need to watch whether Iran manages to find alternative buyers, whether OPEC Plus adjusts quotas to fill the gap, and whether strategic petroleum reserve releases enter the conversation. The cross-asset linkage matters too. Oil spike is sending ripples into equity markets. Energy stocks are popping, but the broader S&P 500 tends to wobble when crude surges because it raises input costs and reignites inflation fears. Keep an eye on the US dollar as well. A strong dollar typically caps commodity rallies, but today the dollar is not the story. Geopolitics is. The 2-week directional lean I have. Cautiously bullish as long as tensions remain elevated and no diplomatic off-ramp materializes. The invalidation of this lean is a daily close back below 71.13. If that happens, The geopolitical bid has evaporated and the bear trend resumes with a vengeance. I want to hear from you right now. Do you think Brent crude closes a daily candle above $78 this week? Comment yes or no below. I'm tracking the consensus, and I'll highlight the most interesting reasoning in a follow-up post. This is your first interaction mine. Drop it now. Now we move into the section most people skip. And that's exactly where the money is made. Keep watching, because I'm about to hand you 3 precise trade setups with exact entries, stops, and targets. These are the plays I'm executing myself. We'll start with 2 scalping strategies designed for today's intraday chaos, then finish with a session swing trade for the multi-day picture. Strategy 1 I call the opening scalp. This is a high-probability momentum continuation play that exploits the first pullback after the spike. Here's the trigger. Price needs to pull back and tap the $75 psychological level, a big round number that will act as a magnet. When it gets there, I want to see a 5-minute candle form a bullish engulfing pattern or a strong pin bar rejection with the low of the candle holding above 74.80. The entry goes at 75.10, just above the high of the confirmation candle. My stop loss sits at 74.65, 15 pips below the round number, giving the trade room to breathe without exposing too much risk. Take profit 1 is 75.80. A quick 25-cent scalp with a risk-reward of about 1 to 1.5. If momentum extends and we see a surge of volume, I'll hold a portion for take profit 2 at 76.40, just inside that overhead supply zone. This scalp is instantly voided if the 5-minute candle closes below 74.80 after the entry. That signals the pullback is not just a retracement but a failure. For the opening scalp, entry 75.10 after 5-minute bullish engulfing, stop loss 74.65, take profit 175.80, take profit 276.40. Invalidation if 5-minute candle closes below 74.80. Strategy 2 I call the liquidity grab. This one is a counternoise scalp that targets the stop hunt zone just beyond the session highs. After a spike like this, late longs pile in above the high of the initial surge, placing their stops just below. Smart money loves to run those stops. Here's how I'll play it. If price makes a new session high above 76.20 and then sharply reverses, breaking back below 76.0 with a 15-minute candle close, that's a failed breakout. I will enter. Short at 75.90, right on the retest of the broken level, with a stop loss at 76.40, just above the wick of the false breakout. Target is a quick move down to 75.30, the nearest intraday liquidity pool. This is a fast trade, requires fast execution, and it works because trapped breakout buyers will be forced to liquidate. The risk is tight, a 30-cent stop for a 60-cent target, giving a crisp 1 to 2 risk reward. Warning, if price pushes above 76.50 and holds, the liquidity grab has failed and the breakout is real. Do not fight it. The liquidity grab, entry 75.90 on a 15-minute close below 76.0 after a false break above 76.20, stop loss 76.40, take profit 175.30. Invalidation if price sustains above 76.50. I want to pause right here and hear from you. Are you scalping this oil spike or are you waiting for the swing? Comment scalp or swing below. I want to see where this community sits. This is your second interaction mine. Let the chat fill up. Now strategy 3, the session swing. This is the trade that captures the multi-session move if the structure confirms a trend shift. I'm not chasing. I'm waiting for a 4-hour candle close above 76.50, that level I highlighted as the first real structural resistance. A close above there on the 4-hour chart, especially if accompanied by a bullish MACD cross on the 4-hour. Would signal that buyers have absorbed the overhead supply and are ready to push toward the daily moving averages. The entry goes at 76.60, with a stop loss placed below 74.20, outside the daily structure, just beneath the old resistance 3 that should now act as support. Take profit 1 is 78.20, just shy of the daily 20 MA where profit taking is likely. Take profit 2 is 81.50, targeting the zone around the 200-day MA. That gives a risk reward of roughly 1 to 3.2 on the first target, and much higher if the second target is reached. Once price reaches halfway to take profit 1, around 77.40, I will move my stop to break even. That removes risk and lets the trade breathe. The explicit invalidation that would shift my medium-term outlook is a daily close below 72.72. If that happens, the swing setup is dead and the bear trend is back in control. The session swing, entry 76.60 after a 4-hour close above 76.50, stop loss 74.20, take profit 178.20, take profit 281.50, risk reward 1 to 3.2 R. Invalidation if daily close below 72.72, risk management pulse, 30 seconds of truth. Never risk more than 1 to 2% of your capital on any single trade. For scalps, I risk even less, sometimes 0.25%, because the velocity requires precision. No positions. Through unscheduled news events. Stops are non-negotiable. If a level breaks, you're out, no questions. This is how you survive to trade the next geopolitical shock, the next supply spike, the next bear trap. The goal isn't to be right on every trade. It's to live long enough to catch the big ones. Let's close this out and set up tomorrow. The single most critical level for the next session is 78.37, the daily 20 MA. If price approaches it and gets rejected, I will be looking to fade the rally aggressively. If it breaks and closes above, the entire monthly outlook shifts from neutral to bullish. Tomorrow, I'll be watching whether the Gulf tensions escalate further or if diplomatic channels open. Any hint of de-escalation and this geopolitical bid will deflate faster than it inflated. I'll have the updated blueprint exactly 24 hours from now, so do not miss it if you want the full breakdown on Bitcoin and the S&P 500 divergence. That video is live right now, tap the end screen. Gold's fear bid is also on the edge of a massive level, and I broke it down yesterday. The link is in the description. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter before the market moves. Hit the bell so tomorrow's alert lands before the open. I'll see you in the next one.